If you own a home in Canada, or have ever sold property, transferred a house to your children, or co-signed a family member's mortgage, what you're about to discover in the next few minutes could save you from a financial disaster that is silently unfolding across the country. The Canada Revenue Agency has activated a new enforcement regime for property transactions in 2026, and at this very moment, thousands of Canadian seniors, retirees, and near-retirees are unknowingly stepping into a tax trap that could cost them tens of thousands of dollars in back taxes, penalties, and compounding interest. The April 30th, 2026 tax deadline has either just passed or is imminent, and if your property transactions weren't reported correctly, the CRA's countdown has already begun. Today, I will break down exactly what changed, why it matters to your retirement security, and give you a clear, actionable plan to protect yourself at no cost. Stay until the end, because your CPP, OAS, and GIS benefits could be at risk if you miss these critical steps. This is information your family needs, and it's information that could change everything. Let's establish the foundation first. Most Canadians understand that selling your primary residence, the home you actually live in, is typically shielded from capital gains tax through the principal residence exemption. This is one of the most valuable tax protections in the entire Canadian system, and millions have relied on it for decades. What almost no one knows, however, is that in 2016, the federal government fundamentally changed the rules. They declared that while the exemption still exists, you must now formally report every single home sale on your income tax return, complete the proper forms, and notify the CRA, even if you owe zero tax. This was a seismic shift from the pre-2016 era, when qualifying sales didn't need to be mentioned at all. The consequences of non-compliance are brutal. Fail to report or report incorrectly, and the CRA can deny your principal residence exemption entirely. Not reduce it, but eliminate it completely. That means your entire profit becomes taxable at once. Now, in 2026, a new layer has been added that is affecting a shocking number of seniors. This involves a concept called bare trust arrangements, which I will explain in detail shortly. But first, you need to understand the current capital gain structure for 2026, because these numbers have changed and they directly impact your retirement math. For property sales that occurred before January 1st, 2026, the capital gains inclusion rate was 50%. That meant only half of your taxable gain was added to your income. However, effective January 1st, 2026, the government implemented a two-tier system. For individuals, the first $250,000 of annual capital gains is still taxed at the 50% inclusion rate. Any gains exceeding $250,000 in a single year are now taxed at the two-thirds inclusion rate, approximately 66.67%. For corporations and most trusts, the two-thirds rate applies to all capital gains with no threshold whatsoever. Why does this matter so much for seniors? Because if you've owned your home for 20, 30, or 40 years, your capital gain could be substantial. Let me show you with a real Canadian scenario. Suppose you purchased a home in Brampton, Ontario in 1991 for $175,000. You raised your family there, retired there, and in late 2025, you sold it for $900,000. Your capital gain is $725,000. If that property was your principal residence for every year you owned it, the exemption should protect all $725,000 from tax. But that protection only works if you properly reported the sale on your 2025 tax return, filed by April 30th, 2026. If you forgot or filed incorrectly, the CRA can deny the exemption. Without that shield, here's what you face in 2026. The first $250,000 of gain is taxed at 50% inclusion, adding $125,000 to your taxable income. The remaining $475,000 is taxed at 66.67% inclusion, adding another $316,750 to your income. Combined, over $441,000 could appear on your tax return as taxable income in a single year. Depending on your province and marginal tax rate, your actual tax bill could easily exceed $150,000, and that's before penalties. The CRA imposes a late filing penalty for an unreported principal residence designation of $100 per complete month, up to a maximum of $8,000 per property. On top of that, they charge 7% annual interest on unpaid taxes, compounded daily. starting from April 30th, 2026, not from when you discover the error. When you combine a denied exemption, back taxes at the new inclusion rates, an $8,000 penalty, and daily compounding interest, the total financial damage can easily reach or exceed $50,000. For multiple properties or higher value homes, it can be far worse. Now, let's address the completely new 2026 requirement that is catching thousands of seniors by surprise: bare trust reporting. Many of you have never heard this term, but you may already be in a bare trust arrangement without knowing it. A bare trust exists when one person holds legal title to a property, while another person is the beneficial owner, the one who truly benefits from, uses, and controls the property. The legal title holder is essentially a placeholder. Here are the most common situations where seniors unknowingly create bare trusts. A parent co-signs a mortgage and goes on title to help their adult child qualify for financing. The parent's name is on the deed, but the child is the real owner. That's a bare trust. An elderly parent adds an adult child's name to their home or investment property for estate planning purposes, hoping to avoid probate. That's a bare trust. A senior holds property jointly with a sibling, friend, or adult child, but the ownership isn't truly equal. That can also be a bare trust. The critical 2026 update is this. For several years, the CRA attempted to mandate T3 trust return filing for bare trusts, but confusion and pushback led to repeated deadline extensions. Bare trusts were exempted from filing for 2023, 2024, and again for 2025. But in 2026, that grace period ended. Bill C-15, enacted on March 26, 2026, is now law. Under this legislation, certain bare trusts must file a T3 trust income tax and information return, including Schedule 15 with full beneficial ownership details, for taxation years ending December 31, 2026. The filing deadline is 90 days after December 31, 2026, which falls in late March 2027. There are limited exemptions. If all beneficiaries are legal owners and all legal owners are beneficiaries, you may be exempt. If the trust holds $50,000 or less in eligible assets like cash or government bonds throughout the year, you may be exempt. A few specific family arrangements also qualify. But here's what you must understand. You cannot assume you are exempt. Many arrangements seniors have used for decades, like adding a child to property title for estate planning, do not automatically qualify for exemption. The penalty for failing to file a required T3 return is severe: $25 per day, up to a maximum of $2,500, plus potential additional penalties for gross negligence. Combined with the principal residence reporting risks, the total financial exposure is staggering. If your name is on someone else's property, or someone else's name is on yours, you must speak with a qualified tax professional immediately about your 2026 bare trust obligations. Let me share 3 real scenarios happening across Canada right now. Names have been changed, but these situations are authentic and representative of what tax professionals are seeing daily. Margaret, age 73, is a retired teacher and widow. She receives CPP, maximum OAS, and a small GIS top-up because her retirement income is modest. In 2025, she sold the family home in London, Ontario for $860,000, a property she had owned since 1988, originally purchased for $140,000. Her capital gain was $720,000. Margaret used the same tax software she'd trusted for years, but the home sale question was easy to skip. She didn't complete Form T2091, the principal residence designation. When the CRA automatically cross-referenced Ontario Land Registry records against her filed return, a red flag was raised. In late 2026, Margaret received a CRA letter demanding documentation. The stress of a CRA review while living on a fixed income was devastating. Even though she was fully entitled to the exemption, her incomplete filing triggered months of anxiety and thousands in accounting fees to resolve. The lesson: entitlement means nothing without proper paperwork. David, age 67, retired after 40 years as an electrician. He receives maximum CPP and OAS. When his mother passed away in 2025, she left him her Winnipeg home. As executor, David sold the property within 7 months of her death. What David didn't know, and what many Canadians don't know, is that the residential property flipping rule introduced in 2023 treats gains on properties sold within 12 months of acquisition as business income, not capital gains. That means 100% of the profit is taxable, with no principal residence exemption and no capital gains inclusion rate benefit. For estates, there are exemptions, but they are not automatic and require precise documentation and timely elections. Because the correct paperwork wasn't filed, David's estate faced an additional tax bill of over $40,000. A few $100s spent on professional advice would have saved tens of thousands. Rose, age 78, lives in Victoria. Years ago, she added her son Michael's name to her home title for estate planning, standard practice to avoid probate. Rose assumed this was a simple, smart decision. What she didn't realize is that this created a bare trust arrangement. Michael holds legal title, but Rose is the beneficial owner. She lives there, pays taxes, makes all decisions. Under Bill C-15's 2026 Bare Trust rules, this arrangement now requires a T3 trust return for the 2026 tax year with full beneficial ownership disclosure. Failure to file triggers penalties. Rose's situation mirrors hundreds of thousands of Canadian seniors who made practical estate planning decisions years before these rules existed. They are now retroactively captured by regulations they never anticipated. These three Canadians had different circumstances, but share one common thread. They followed normal, common-sense practices, and the tax rules changed around them without adequate warning. That is precisely why this information matters today. Now let me address something critical for every senior receiving government retirement benefits: the direct connection between these property tax issues and your OAS and GIS payments. As of the April-June 2026 quarter, the maximum OAS payment for seniors aged 65-74 is $743.16 per month. For those 75 and older, it's $817.36 per month, reflecting the permanent 10% increase implemented in 2022. The maximum GIS payment for a single, widowed, or divorced senior is $1,065.47 per month. Combined, a low-income single senior could receive up to $1,809 per month from OAS and GIS, or about $21,700 annually in essential tax-free income. For many, this is survival money. Here is the critical connection. Your GIS amount is calculated entirely based on your previous year's tax return income, and it is recalculated every July based on the return you filed by April 30th. If you failed to file your 2025 tax return by April 30th, 2026, your GIS payments could be suspended starting July 2026, not reduced but completely suspended without warning. For a senior receiving maximum GIS, that's over $1,000 per month disappearing overnight. Retroactive GIS is only available for up to 11 months of back payments. Longer gaps mean benefits are permanently lost. There is a second danger. If the CRA reassesses a prior year and adds a large capital gain to your income due to an unreported property sale, that income spike can devastate your GIS eligibility for the following year. Suppose the CRA reassesses your 2024 return and adds a $200,000 capital gain because you didn't properly report a property sale. Your 2024 income now appears dramatically higher. Since GIS for 2026 is based on 2025 income, the cascading effects can be complex and brutal. There is also the OAS recovery tax, commonly called the clawback. If your net world income exceeds $90,997 in 2026, the CRA claws back 15 cents of OAS for every dollar above that threshold. A large unexpected capital gain from a reassessment could push your income over the limit and trigger an OAS repayment demand. I'm not sharing this to frighten you. I'm sharing it because understanding these connections empowers you to act now before there is a problem, rather than scrambling to fix one after the fact. Now let's get to the most important part, your action plan. I will walk you through this step by step, clearly and simply. Step 1. Identify every property transaction since 2016. Sit down with a notepad and list every property you have sold since January 1st, 2016. Include your principal home, cottage, rental property, condo, vacant land, or any residential or investment property. Also note any properties transferred to family members even if no money changed hands. If you sold your home in 2025, that sale must be on your 2025 tax return filed by April 30th, 2026. If you missed the deadline, file immediately. The late filing penalty for a T1 return when you owe money is 5% of the balance owed, plus 1% for each additional month, up to 12 months. Every day of delay increases your cost. Step 2. Verify your home sale was properly reported. Pull out your tax return from the year you sold each property. Look specifically for Schedule 3, the capital gains schedule. A correctly reported principal residence sale should appear there, along with a completed Form T2091, the designation of a property as a principal residence. If the sale is missing from Schedule 3, or if Form T2091 was incomplete or absent, you have a problem that must be addressed immediately. Step 3. Explore the voluntary disclosure program for prior years. If you sold a property between 2016 and 2024 and failed to report it correctly, do not wait for the CRA to contact you. The voluntary disclosure program allows you to come forward voluntarily, and if accepted, you may receive relief from penalties and possibly interest. However, the moment the CRA initiates a review or sends you a letter about a specific property, you lose access to the full protections of this program. Act before they do. Step 4. Determine if you are in a bare trust arrangement. Ask yourself, is my name on someone else's property title even just to help with a mortgage? Is someone else's name on my property even just for estate planning? Did I add an adult child to a property title? If you answered yes to any of these, speak with a tax professional this year about your potential T3 filing obligation for the 2026 tax year. The T3 deadline for 2026 is 90 days after December 31st, 2026, which is late March 2027, but preparation takes months. Start now. Step 5. Protect your GIS by filing on time every year. This is non-negotiable for GIS recipients. File your tax return by April 30th annually, even if you have zero income to report. Your GIS renewal depends entirely on filing. If you missed April 30th, 2026, file immediately. Retroactive GIS is capped at 11 months of back payments. The Community Volunteer Income Tax Program, CVITP, offers free tax filing assistance to eligible Canadians, including seniors with modest incomes. Find your nearest clinic at canada.ca or call the CRA at 1-800-959-8281. Step 6. Protect your estate from the flipping rule. If you plan to leave your home to your children through your estate, consult both a tax professional and an estate lawyer before taking any action. The residential property flipping rule, which treats gains as business income when a property is sold within 12 months of acquisition, can apply to estates in ways that feel punitive but are legally enforceable. The 2026 federal budget proposed better estate protections from this rule, but that legislation is still moving through Parliament. Until it becomes law, estates remain exposed if a property is sold within a year of the deceased's passing. A few $100s in professional fees today can save your family tens of thousands tomorrow. I want to explain why the risk in 2026 is higher than ever before, so you understand this is not theoretical. The CRA has invested heavily in data matching technology. They now automatically cross-reference land registry records from every province against filed tax returns. If a property sale appears in the registry but not on your return, a flag is raised automatically. There is no human discretion in that initial trigger. Second, the Bare Trust legislation in Bill C-15 includes mandatory beneficial ownership disclosure, which means the CRA is building a database of who truly owns what. This is a fundamental shift from the previous honor system. Third, after years of delays, the political will to enforce these rules is strong. Governments at all levels are under pressure to address housing affordability and tax fairness, and enforcing property reporting is seen as a key tool. The result is that seniors who made innocent decisions years ago are now in the crosshairs of a system that is actively looking for non-compliance. Please take a moment right now to hit the like button. It takes 1 second, but it signals to the platform that clear, accurate, plain language information about Canadian retirement benefits and tax obligations is valuable, and helps reach more seniors who need this knowledge. If you haven't already, subscribe and turn on notifications. Every week, we deliver updates on CPP, OAS, GIS, CRA rule changes, and retirement planning, all in plain language, all completely free. Every Canadian senior deserves access to this information. Drop a comment below and tell me what city or province you're watching from. Write something like, "Watching from Saskatoon, Saskatchewan," or "Hello from Halifax." I read every comment, and knowing where our community is located across Canada helps me tailor future content to your specific regional concerns. And please share this video. Send it to your spouse, your friends, your adult children or grandchildren who help with your taxes. You might save someone you love from a painful, entirely avoidable financial crisis. Thank you for watching. Take care of yourselves, take care of each other, and stay informed. Your retirement security depends on it. Smart Pension Canada.